by trying to avoid paying the tax on something now, you're preventing yourself from saving tax on the future growth on a future transfer. So ripping that Band-Aid off at the time to pay the tax now is often the best way to go.
Sounds painful either way.
It's about minimizing that potential pain.
So you've spoken a little bit about there's some ways around this. Mm-hmm. And I know that, one example is with the TFSA. Maybe you can talk a little bit about that.
Similar to the RSU example, once they vest and they become your shares, you own them.
Right.
So you've paid your tax up front, you now own the shares, but on a go-forward basis, if they're sitting in your company stock plan account, it's a taxable account.
Okay.
So the growth in the value of those shares in the future will be taxed as a capital gain.
So that would be your Fidelity account or something like that?
Exactly. Now, when you acquire these shares on day one, because the cost base is equal to the fair market value, you could contribute those into your TFSA on that day that you earn them. And in doing so, now all of a sudden the TFSA will be shielding the future growth from tax on a go-forward basis. The other scenario that we see a lot is just the individuals who have that gain who maybe don't necessarily want to pay the tax. But by trying to avoid paying the tax on something now, you're preventing yourself from saving tax on the future growth on a future transfer. So ripping that Band-Aid off at the time to pay the tax now is often the best way to go.
Right. Sounds painful either way.
It's about minimizing that potential pain.
For someone who's in the position where they've already got a bunch of shares in their brokerage account with work, Fidelity, Morgan Stanley, whatever the case may be, for that individual who may be hesitant to sell their shares just because they don't want to pay that capital gain, there's what's called the Section 85 rollover. Okay, so the Section 85 rollover for individuals is a great way to help someone diversify out of their company shares without triggering the capital gain. Okay, so at from a 30,000-foot view, you would exchange your company shares for shares in a corporate class mutual fund. And when you do that, you would crystallize the market value and the cost-based characteristics of those two assets such that they're the exact same. And so because they're the exact same, when you exchange one for the other, you're not triggering the capital gain. And so the benefit of that is you get diversification in the portfolio without sending all that money away, that capital gains tax to the CRA. You keep all that money in your portfolio growing and compounding over time. And then eventually when you go to sell that position, hopefully years later when you're in retirement, i.e. a lower income tax bracket, you're paying a whole lot less in the way of capital gains than you would have to get out of that position while you're in a high income tax bracket.
Was the Section 85 rollover developed by tax accountants just to confuse and bamboozle the rest of us?
Sometimes it feels like the Tax Act, which is a phone book at this point, is meant to confuse and make things challenging for people, but it's really a unique mechanism that allows someone to transfer an asset into a corporation and effectively defer the tax.
This just proves that you really need to speak to a financial advisor because this is like home dentistry. It's never a good idea.
This is a very complicated topic in the realm of tax, and it's not something you can do at home.
Right.
So by all means, if this is something that is of interest, consult a qualified professional.